we go. 5, 4, 3, 2, 1, first time.
Hello, and welcome to this episode of the Ask Valor Masterminds podcast, brought to you by A Advanced Services and Fuse Networks. My name's Galen.
I'm Joe.
We're coming at you live from the Creative Block Studios in Seattle, Washington. So, Joe, to our live listeners and viewers tuning in, how did our podcast come to be?
Sure. So it first started out as a private Facebook group page where the purpose was to bring business owners together, just to kind of communicate with one another, talk, ask questions, share tips and advice. And because we're a marketing company, we get a lot of questions outside of just marketing. And so we thought, what a better way than to bring on different guest speakers to talk about all different topics as it relates to business.
Awesome. And today's topic is how to achieve generational wealth. We're lucky to have an in-studio guest today, Mr. Sean Ostrander. And just come find out that our two sponsors, we have kind of links to and everything, which is kind of cool with A Advanced and Fuse Networks. Joe, start off Sean's formal intro, please.
Sure. So Sean Ostrander is the VP of JD Merritt Investment Bank and has been advising and executing on M&A transactions for 10 years. Sean has executed sell-side, buy-side, and advisory mandates across a variety of industries in excess of $1 billion in enterprise value. He is a certified mergers and acquisition advisor and holds a bachelor's in business administration and a minor in theology from Masters University.
Sean has a passion for service after spending early years of his career at Nordstrom and is passionate about working with family and closely held businesses to create liquidity and capture the value they've created in their companies. He lives in Gig Harbor, Washington with his wife, Amy. Everyone welcome Sean.
Thanks, guys. Glad to be here.
All right.
Sorry about this.
So usually when we do our podcast, we like to ask our guests some questions to get to know them, the individual. So this first question is, what are some early lessons learned as an entrepreneur?
Let's think about that. Probably the earliest lesson that I learned, or I guess that I had to learn, was essentially that showing up every single day was probably going to be one of the bigger differentiators that I could have in my career. Integrity is rare was another thing that I discovered. I showed up in this business not exactly knowing what I was going to get myself into, and just kind of learned and failed and kept showing up and kept trying every day. And essentially 10 years later, I'm just now starting to think that I know a little bit about what I'm talking about, but man, it's also one of those things where the older you get, the more you realize you don't know. I think the other thing is just, in general, the bar for excellence, and again, showing up every day and just doing what you say you're going to do, is much lower than I built out in my head. I was intimidated getting into this industry, into the finance world and the business world in general. And again, just being honest and doing the work has allowed me to build a decent career so far.
Awesome.
So in your years of business and getting started, what's been the best piece of advice that you've been given?
Yeah, I think the best piece that I had when I graduated college, I was working part-time for a dashboard analytics business, and then doing sales for them, and then also for Merritt Harbor Group at the time, with Craig Diggins and Nick Devaney, who I'm still working with today. And essentially I was part-time. And I was told by a mentor at the time, Bob Hinton, who's with Moss Adams, I was told, be all in. The idea of spending 40 hours a week, like if that's your barometer of like what your work week looks like, it isn't about the hours, it's about, did you do the job? Yep. And did you own it, right? And essentially, I made the call, like at a certain point I had to realize, okay, if I'm going to be good at one of them, I have to pick one.
Right.
So ultimately I went the finance route and just found a passion for doing deals and, finding ways to connect buyer and seller and essentially help sellers create generational wealth like we're talking about today.
Awesome. So since this technically is a marketing podcast, why is marketing important in your view?
Yeah, you guys were saying earlier that marketing's boring. I laughed at that just because when you think about marketing, marketing is this amorphous kind of topic. There's so many different flavors of it, and it's very hard a lot of times to track the ROI on the marketing. You guys as marketers may be able to look at someone's data and say, hey, here's your ROI on this, and that's part of the marketing service you provide. But so many times marketing companies don't end up holding on to clients because they can't show the actual ROI.
Right.
Especially in today's digital age when you have so much on pay-per-click and so much data that is trackable and traceable. The difference there, I mean, you've talked about Advanced, right? I mean, the difference of their growth working with you guys, over the years is really couldn't have happened without essentially knowing your why and communicating your why to the marketplace. And the bar is low, like I've said before. It's simple of if you be good at something,
Right.
do a service well or sell a product well, make it well, and essentially do what you say you're going to do. But the messaging there, no one knows that exists and why you're different unless they actually spend the time and effort and resources to do the marketing well. So,
All right. Awesome. Now we come to the part of our podcast, our advanced services, pump you up quote of the day. So I'll read this and get a thought from you. Patience and diligence, like faith, remove mountains. From William Penn. So why is that quote important to you, or why does it resonate with you?
resonates with me because I have had an abnormal career. Like I told you before, if you look at my kind of education, you look at my background, I grew up in an entrepreneurial household where my dad, Todd Ostrander, who I work with at Merit Investment Bank today, he was a founder of multiple different startups and venture-backed businesses. Did really well in those. But I saw a lot of volatility. And essentially, I ultimately decided to go the investment banking M&A route so that I could have some stability while still having a lot of opportunities for upside and be surrounded by the smartest people that I could possibly, at the time at least, be surrounded by. So essentially, working with all these business owners, every client that I've been able to work with, I've learned something from, right? It's just by the nature of being in the room where it happens, and just learning and absorbing and shutting up when you need to shut up and speaking up when you need to take a shot.
Yeah.
I've done that for 10 years now, and I've been at the same place. And a lot of people in the finance world will spend kind of 2-3 years, then they'll jump. And there's plenty of reasons why people do that, right? Everyone's situation is different.
Right.
I've been incredibly blessed to, at every time that kind of opportunity has presented itself, have a situation where I've looked at it and said, I still have more to learn. I still have more where I'm still able to see my wife at night. I'm still able to spend time with my family and be present. So I think that patience, because I have kind of showed up, put my head down, I look back and I have no regrets.
Awesome.
On kind of what I've done there.
Why do you think it is that people change in the banking and investments so often? Because I do see it like all of a sudden you've been 2 years here and now you jump ship and you go to this company and you get a new title and then a new opportunity opens up and now you go to this one. And why is it that it seems like in the financial and your industry, people are not loyal to one company?
I think a lot of it is that the companies aren't always loyal to them. In the financial services space, it's just that it's financial services, right? So end of the day, no one is more focused on building wealth and building profit, maintainable profit, sustainable profit, more than financial services businesses, right? Whether it be wealth management, whether it be investment banking, M&A, whether it be banks in general, right? I mean, it's all about continuing to grow the bottom line and the top line. And end of the day, I think where businesses are more corporate, it's harder to keep the relationship with the employees there, right? That's something that's really mattered to me, has been, I really like the people that I work with. They're some of my closest friends, right? It is the people that I've, Craig, Nick, Joel, the guys that I work with. I see my dad every day, right in the office, and I love that. It's a fun dynamic. But it's also something where, it creates other dynamics, right? Like anything else in a business. But again, I've been able to share and be vulnerable when my personal life with them.
Yeah.
They're truly friends.
Yeah.
And that just doesn't happen that often. So when that doesn't happen with other employees, they end up having to look at things. And if you're offered 20, 30, 40 grand else by someone else, people are going to make that move.
Yeah.
So
Cool. Now we come to the part of our podcast, our Fused Networks Did You Know segment. So there's a couple myths that I have. I shared with you right before you went on. I'm going to read them and get a quick thought. So this first myth, actually, Joe, you want to read that first, please?
Millionaires usually come from generational wealth. True or false?
And yes,
I
before
would
you
say
answer,
false.
it is from the Ramsey Solutions. So what you referenced earlier.
I'm a points and miles hacker. So
Okay.
the Ramsey's thoughts on credit cards I always laugh a little bit about, but so that's why I was giving a hard time on that. It's false. Do I have the data in front of me to say why it's false? No, but what I can say is that most of the millionaires in this country, I feel, and working with a lot of them, they have taken an idea and built a business and done exactly what that quote said, which was essentially they put their head down and were patient and diligent in showing up every day and doing the work.
Yeah.
Right now, especially through COVID and just all of the changes in the economy, there's a lot of other millionaires that have become millionaires through a lot of different reasons.
Yeah.
Also, a lot of times when kids are given money, they don't hold on to it very well.
Right.
That
true.
can happen,
Yeah.
right? And I think that's part of, we don't just work with the clients we work with. We try to surround them with advisors to ensure that, that doesn't happen. So anyway, I would say that's false.
So to back you up, I'll just read the stat.
Yeah.
So Ramsey Solutions survey of 10,000 millionaires, only 2% responded that they came from families considered upper income. So to your point. All right, this next one. Generational wealth is always massive. So let me read this and then get your thought. The term wealth is misleading. Just because you have something to pass on to family members after you doesn't mean you're a billionaire or even a millionaire. According to Investopedia, more than half of American family inheritance were less than $50,000 between 1995 and 2016, and only 2% were more than $1 million. Wealth is also defined differently from one family to another. We were talking about that before we went on. Wealth to one family can mean enough money to retire or pay for future children or grandchildren's college fees. It may simply mean to have a safety net in case of emergencies or money to pass on as gifts. So generational wealth is always massive. Your thought on it?
Yeah, like you said, it kind of depends on your definition of massive. To someone that grew up with nothing, $100,000 is massive,
Right.
and they can stretch that. I've seen a lot of people where $40 million is just not going to cut it. Which, to us, we'd say that's a good chunk of money, right? That is generational wealth. But, to your point, someone can be gifted stock in a business that all of a sudden explodes, right? And that can be the greatest gift that they ever got, right? But you don't know it at the beginning. So, yeah, it's a little bit tough to pin that down.
Okay. This next one, Joe, why don't you read this one?
I'm only giving it because you just already said it, but
Okay.
all family members are smart about money.
Many can be smart with money.
The ability to.
All of them know. All of them know. Just for the same reason that so few people, or so few, so small of a percentage of the millionaires are, coming from wealthy families. There's a difference of building your wealth, building your own, building your own story, building your own business, etc. There's something in the ownership there of managing it well and being prudent with it. When you're given something, it's the odds that someone manages that well is just lower. If someone wins the lottery, you see a lot of people win the lottery, and things go sideways pretty quick.
Right.
The broke
It's almost
people.
building like the legacy piece of building a business where almost like sustainable wealth. So let's get into it now. How to create generational wealth. When people hear the term generational wealth, they think of a lot of different things. We debunk some myths now. To our audience out there who are comprised of small business owners, entrepreneurs out there, they have a business and they may be close to retiring or starting to think about it. What would you say to those people when they start thinking of that term generational wealth? Because that means you're starting to think more than yourself, right?
Yeah.
You're going to leave it to someone else, if it's a family member or not. Share your quick thoughts on like the definition first.
Yeah, so I guess definition, I'd say that definition has changed for me in the last 3-4 years, especially through COVID. I think that's changed for a lot of business owners.
Right.
It's changed for a lot of families, whether you own a business or not.
Yeah.
I think what it's forced people to do is look in the mirror and say, how much of my time is my own? And a lot of people have said my time is worth more to me now than it was before.
When
Agreed
time
with
is defined as an asset now,
When time is divided as a resource,
not just money or
Yes. So whether there's a lot of reasons for that, right? COVID put death and risk of dying and sickness right in front of a lot of people, where they hadn't really thought about it before.
Right.
So that's changed a lot. So I think when we talk about generational wealth, it's there's a lot of people that are rich, right? But if I look at my checking account over the next 6 months. Well, no, let's say 7 months, right? Because the tax bill is going to be due next April, right?
Right.
If I look at my checking account now, I go, okay, great, I have this much money here. But then the tax bill comes, and okay, now I have less money, right?
Right.
So did I really ever have this money? If I was preparing to pay the bill, I would say no, right? So it's the same kind of thing where people are saying they're weighing, okay, do I have an asset in a business, or do I have wealth that can create ongoing wealth for me, where I can buy back some of my time,
Right.
or do I have to keep building that? And for some business owners, some businesses just aren't sellable, right? Some of them are there isn't a buyer for it. It's super niche, and that person is really good at that business, but they're essentially selling their time, which some people can sell their time for insane amounts of money.
Yeah.
Taylor Swift sells her time for a lot of money, right? Football players, same kind of thing, right? They sell their time.
Yeah. Taylor made Travis Kelce famous, right?
Yes.
There you go.
Yes.
I mean, he was famous before then.
Yes,
No, not to the Swifties.
Not to the
let's
Swifties.
talk to the audience, right?
Not to the $400 jerseys.
So, but end of the day, it's through COVID, people essentially that had businesses are just saying, okay, what do I actually want to build with this business? Do I want to take this risk of continuing to hold it, or do I want to create an exit plan for myself? So that's kind of what I would say. That's how the landscape has changed.
Are there steps that businesses can take to make sure their business does create generational wealth?
Yes.
And what would those steps be?
I would say
Maybe like 2 or 3 steps.
Yeah, so I would say it depends. If the purpose is creating generational wealth, you have to decide if you are going to be the person that is going to be the ongoing creator of that wealth by selling your time, right?
Right.
If you are continue to own the business, run the business, and operate the business, and you have to show up to run that business 80 hours a week, you may have the money in the bank, but again, like I said, a lot of people are saying, hey, I want to spend more time with my family. I've worked hard. I have the money.
Yeah.
What's an extra, in a lot of business owners' minds, what's an extra 10 million if I have 40 here, right? I mean, that's
Right.
that's kind of the calculus that people are going through. So as far as kind of steps to take, you have to identify first who is going to run the business if I want to move on.
Right. A successor plan.
What's the successor plan? A lot of people think it's their kids. Reality is it's rarely their kids.
Yep.
It's rarely the kids, or they say, hey, I want to do this, or they take over for a couple of years and
It's not my thing anymore.
it's not my thing anymore, and they go, I'm gonna go sell the business.
I'll sell it for what I could get and
Right.
Yeah.
on to the next thing.
Right, and by the time that happens, performance is down dramatically,
Yeah.
and they can't sell it for nearly
Then your
what they could have
company's
before, right?
devalued because
Yes.
of the neglect.
So if it's not the kids, then is it your management team? Are you missing a key point to run the business, right?
Yeah.
And that's probably the biggest piece that, like, when we represent a business owner or a set of stakeholders that own a business and they're looking for a buyer, that's the first question is, okay, what does the sellers want to do? We talk to private equity, whether it be private equity, whether it be a strategic buyer, right? You're a bigger competitor in your space. It's always the first question: what do they want to do? Do they want to retire? Are they looking for a partner? A lot of times, the best deals can happen when the owner wants to continue to run the business, where they can roll over a chunk of equity, take some cash off the table.
Right.
But again, from a buying back time, that doesn't fit for a lot of sellers. But it's a risk. It's always a weight of risk, right? The value of your business is a function of what does the go forward business look like, and how can I structure a deal around that go forward business. If this seller has tight relationships with 20% of the customers, and they're going to leave, you kind of have to assume that some of those customers are going to go.
Yeah.
So
Right.
you have to underwrite a business based on that. So that's part of what we navigate is how do you best position a business to kind of garner the best value in the market, fully adjusted for all the noise in the market. And it's a noisy market right now. I will say
So
that.
do you see now with businesses with COVID, because there's some businesses that have separated themselves over the competition. Do
Yeah.
you see now like bigger companies buying the smaller companies as a way to strengthen like their position in the marketplace?
Yeah, so I mean, depending on the industry, I mean, we're talking about the septic space in Pierce County out here, right, in the Seattle area. Very fragmented space. You have a lot of people that are 3 or 4 employees, and they own 2 trucks, and they're getting a lot of government work, right, or a lot of municipal testing work or whatever that looks like, right?
Right.
But there's tons of septic companies out here, right?
Yeah.
There's a lot of businesses that are financially backed, that have a private equity owner in New York or Chicago or LA, or there's a bunch here in Seattle, where they're kind of looking at rolling up their market. So they'll say, hey, we want to own Washington, right? Flowhawks has done that.
Yep.
Advanced is doing that, right?
Right.
Where they kind of own a market. And then from there, they identify, again, all those businesses, right? There's an exit plan, right?
Right.
There's, a business that is, 200, 300 million in revenue that is owned by a private equity firm. They have an exit plan at some point,
Yeah.
right?
Right.
So, I would say that the fragmented kind of side of things and people, or I guess businesses rolling up smaller competitors, that's not new from COVID.
Yeah.
Right.
I would say it got a lot easier
Yeah.
in 2020 and 21 when
It
interest
expedited-
rates were so cheap.
And it expedited people's exit strategy. Like,
Yep.
it's a good time. It's a sign. Like, I want to get out.
Yep.
Before it's
so,
too late kind of
So
thing.
when interest rates were so low,
Low, yeah.
what happened is you had this separation. You had, basically the lower middle class and the middle class being given free money by the government.
Yep.
People that kind of knew how to, or I guess what happened is with all of that extra capital, a lot of that capital ended up in private equity's hands.
Right.
So they were able to, they had not only a lot of dry powder, a lot of cash to deploy, and they still do. I think it was 420 billion as of the end of 22 was dry powder on the sidelines. That's in the U.S. middle market.
That's a
private
lot.
equity firms.
That's a
420
hel-
billion.
That's a healthy amount.
It's a ton of money, right?
Yeah.
Now in 2020, 21, combine that with sub 5% interest rates on
Yeah.
senior term loans, the valuations got silly, right? And people were basically it was just like buying, when homes were getting bought with no inspection, right?
Yep.
Right.
But,
Sight unseen
They were
and-
basically able to just go, okay, let's just,
Sign the document and let's go.
let's just go.
Yeah.
So now diligence is a thing, right? Diligence has always been a thing. I would say it's gotten tougher in the last 18 months, right? Because businesses are reacting to higher interest rates. Operations are slowing, right? As, the cost of capital changes for everybody. So I'd say there's a lot of industries that are doing really, really well, and a lot of really good deals are still getting done at great valuations. But it's a lot more, the why, the strategic rationale for those deals has to be a lot more rock solid than it was kind of during COVID.
Are there specific industries that do better in creating generational wealth?
I'd say the unsexy services businesses.
So like the poop business. and
Yes.
the-
Yes.
Everything home service related.
Yes. So HVAC was
Yeah.
really, really hot for a while, and it still is pretty hot. But a lot of that is because of the contracts, right? It's the stability of the revenue.
Yep.
And with HVAC, a lot of that is insurance covered, right?
Yeah.
When it's, not only commercial, but also residential. Like, I mean, I had home warranty on my first house, right? And I had to replace the heater, a year and a half into it, right? Again, covered by insurance. I didn't really care who got hired, right? Because they coordinated
Yeah,
it.
just as long as
right?
it got taken care of for you.
Just as long as it got taken
I'm
care
in
of.
that situation right now
Yeah.
with water damage
Yeah.
and mitigation.
Yeah.
So.
It's those, so that example right there of you dealing with what's going on in your house, you need it fixed now. You don't care who shows up. You want to make sure that you get like a reasonable bang for your buck.
Right.
But you're not going to spend 2 months shopping it.
No.
You need to make a decision now, and it's those businesses that end up doing really well. But it's kind of the mission critical businesses where there's a very clear why. Now there's a lot of businesses where they're in that space. They just can't differentiate themselves among the noise because it's a very fragmented market.
Yeah.
There's a ton of plumbers out there, tons of them.
Ton.
Right.
In any market. Yeah.
In any market, right? There's tons of plumbers.
Because margins are so high, everyone's trying to chase that.
Because
right?
margins are so high, and I don't know how to repipe my house, right?
Yeah.
Yeah, you can only do so much on YouTube DIY.
Exactly.
So.
Exactly. So like that person is able to, as a standalone plumber, make a ton of money for himself, but he can't sell himself as a business.
No.
Right.
Right.
So anyway.
One last question.
Yeah.
So with businesses or people out there trying to create generational wealth, what's one thing you see people do wrong when they try to do it? Is there one common thing like it's blaring like, don't do that? Oh my goodness.
Yeah.
What is that?
I'd say the hardest part when we work with a new client, my first question is I try to get a sense for the financial, the books and records. I try to get a sense for the accounting. Have you, done all the accounting strictly? Not that a cash basis is always bad, but it's not in market. It's going to have to be adjusted through a quality of earnings, et cetera. So I try to get a feel for, have you managed the business just for tax, to minimize your taxes, or are you running $500,000 more of your personal expenses or your family expenses through the business, where that shouldn't be done, and or are you really underreporting your inventory,
right.
so that you don't have a massive tax bill coming to you. I've kind of seen it all, right?
Right.
Now I'm not an accountant. It's not my job to be an accountant and to say, hey, you need to talk to me, whoever about this. But I look at it through the lens of, can I go to a marketplace of potential buyers, and will you close, right?
Yeah.
Are you going to be able to survive diligence? A lot of businesses can't survive diligence. So when you're starting to plan for and think about selling the business or trying to find out an exit plan, you want to. A lot of people talk to their attorney first. There's some fantastic M&A attorneys in the area, and there's 3 or 4 that by name I would say, hey, any of these guys are great.
Right.
But at the end of the day, your attorney is going to get your documents, your corporate records in order, right?
Yeah.
But how to go to market, talk to an investment banker like myself, talk to an M&A advisor of some sort, because at the end of the day, how you present to the marketplace, the difference in presenting that to the right subset of buyers,
Right.
Messaging it as something where there is a huge upside and future for your business without you,
Right.
versus just saying, hey, my buddy down the street owns a business that's similar to mine. I'm just going to sell it to him. Here's my books, and hoping that everything's going to be fine. It's not that easy, and you're probably leaving millions on the table, truthfully.
So for people that want to get a hold of you, what's the best way to contact you, our audience?
Yeah, merritinvestmentbank.com. I'm on LinkedIn, Sean Ostrander. It's probably the best way.
Awesome. So before we go, talking about exit strategy, but an entry strategy for a small business is usually a website. So talk to us about our #ValorCares initiative real quick.
Yeah. So if you own a business, and whether you're a startup company or whether you've been in business for multiple years and your website is garbage and you just need a new one built, you can jump on AskValorMasterminds.com, click on the Valor Cares page and submit your information, and we'd be happy to build you a free website.
Awesome. Thanks for that, Joe. So on behalf of our sponsors, A Advanced Services and Fuse Networks, my name's Galen.
I'm Joe.
I'm Sean.
Sean, thanks for joining us in studio. It's
Thank
such
you,
a
guys.
cool
Thank you.
dynamic coming from the Creative Block Studios in Seattle, Washington. Hey, everyone, thanks for watching or listening to this episode of the Ask Valor Masterminds podcast. Thanks, guys.